Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In this second part of our episode on scalping, we are going to focus on an idea I believe is absolutely central to intraday trading: market structure statistics. One thing I've consistently noticed among skilled intraday traders is that they develop an intuitive feel for the numbers. They understand almost instinctively how the markets tend to move, where the opportunities are, and as importantly, where the opportunities don't exist, so that they don't trade in those places or on those days. That intuition usually comes either from years of screen time or based on deliberate research. Using market structure data as a framework can dramatically shorten your learning curve. It helps you make better trading decisions and, equally importantly, avoid poor ones. That's why I believe it is foundational. So without further ado, let's get started. Disclaimers first. The ideas and examples shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in derivatives involves significant risk and can result in complete loss of capital. The examples and data presented are meant to explain market behavior, not to suggest that similar outcomes will occur in the future. Outside of the risk disclaimers, note that this episode is data heavy and may need you to pay close attention to the numbers to make any sense of it. With the disclaimers done, let's get started. The most fundamental thing when it comes to scalping is that you want the instrument to move. Only if it moves does the question of predicting the move and making money from it arises. The move that we are referring to is what is measured through range. When I say range, I mean high minus low range for any given time frame. It can be daily, hourly, or any specific time window. This value, when looked at as a percentage of, say, open, gives you an idea of how volatile an instrument is. To give you an idea, here's the median and mean intraday range as a percentage of open for Sensex, Bank Nifty, and Nifty. What this means is, if you are looking for large moves, Bank Nifty offers better opportunities than both Nifty and Sensex. But as with anything that moves a lot, large moves can also be both an opportunity and risk. If you are a beginner trader, it's easier and safer to trade a slightly less volatile product. Further in the episode, I will focus on Nifty 50 as I present more market structure related statistics. Now let's move to the next hypothesis to understand how an index range forms during the day. For instance, in a day, let's say the index makes a range of 100 points. How much of it happens during what time of the day? To understand this better, I break the day, which is 375 minutes, into almost equal three segments: 9:15 to 11:27, 11:30 to 1:27, and 1:27 to 3:30. Now, these numbers are based on 3-minute data, and that's the reason why you see 27 and 30. Now, each of these segments are labeled as S1, S2, and S3. Let's understand S1 better with an example. Now, S1 is 9:15 to 11:27. 11:27 close, that is, because we are talking about 3-minute bars. Let's say index opened at 25,000 and made a high of 25,050 and a low of 24,990, which means a range of 60 points by the end of the 11:27 bar, which closes at 11:30. So that's what is S1 and that's what happened in S1. Now let's move to S2, which is 11:30 to 1:27. Now let's say the index moves further up and makes a new high of 25,070, which means now the total day range is 80 points, as the low remained the same, but we got a new high. Lastly, we have S3, which is segment 3. which starts at 127 and ends at 330. Let's say again the index made a new high of 25,100 and closed at 25,080. Now the range has further extended by 30 points, so the total range now will be 25,100 minus 24,990, which is 110. Now of this 110, if we have to figure how much of it happened in S1, S2 and S3, we would have to do the following. So S1 gave us 60 points, which means 60 divided by 110 into 100 gives us 54%. S2 gave us 20 points, so that would be 20 divided by 110 multiplied by 100, that's 18%. S3 gave us another 30, so that's 30 divided by 110 multiplied by 100, that gives us 27%. I hope you got the math. Now look at this chart. Almost 70% of the day's range gets done in the first 2 hours, leaving very little for the rest of the 2 segments. However, between S2 and S3, the last 2 hours, that is S3, offers better and greater range expansion opportunities. On rare occasions when S1 has a very narrow range, the odds of range expansion in S3 significantly increases. Now look at this chart. You would see it in the data, though not many days in the year when it happens. 2026 seems to be an anomaly where a large part of action happened in S2, but we have limited data for 2026. It's also possible that downside expansion happens a bit early or has been happening a bit early in 2026. Moving on to the concept of clustering of patterns, there is another thing that plays out in the index. The S3 expansion happens in clusters. There are months and periods where afternoons or S3 breakouts are dominant. As you can see in the visual, 2023 was a S3 dominant year with Feb, June and December biased towards S3 days. Feb was again dominant in 2024, same for March 2026. Back to range-related statistics. Let me ask you a simple question. Imagine it's 9:30 in the morning right now, 15 minutes post-open, and the range is X something. If the index breaks out on the upside or on the downside, how many more points can it do in the next 2 hours? That's the question. Fair enough? Because as a scalper, that's what you would want to know, right? What you see here is year-wise median and mean initial range, that is 15 minutes range points. Then the number of days with the upside breakout and the number of days with the downside breakout. More interestingly, you also see a median IR multiple after breakout. It means if 9:15 to 9:30 range was 100 points and you get a breakout on the upside based on the 3-minute bar close, on an average you can expect around 61 points extension till 11:30. To give you a more relatable day-wise examples, let's look at what happened in the past 10 days. As you can see, this doesn't play out in a linear way. There are days where you get no breakouts and there are days where you get close to the median, and then there are days which give you double that. The broader point I am trying to make is this market structure stat helps you understand how the price action plays out after a breakout. Another important distinction to make in intraday trading is trend days versus mean reverting days. Let's start with defining a trend day. To measure a trend day, we have taken a simple calculation. We divide the day in 3 segments, the same S1, S2 and S3. The time definitions for each of those segments remain the same. Then the first condition for a trend day is that the day has to show a clear staircase-like pattern across the day's 3 segments. Each segment has to make both a higher high and a higher low than the previous one for an uptrend day. And for a downtrend day, each segment makes both a lower high and a lower low. For example, for an uptrend day, the price action must look like a rising staircase across the 3 time blocks. Let's understand it with an example. Now let's start with segment 1, S1. And let's say the range is 22,000 to 22,100, which is 100 points for segment 1. For segment 2, the range is 22,050 to 22,150. So we have a higher low of 22,050, which is greater than 22,000, and a higher high of 22,150, which is again greater than 22,100. The range is 100 again. Segment 3 S3 range is now 22,120 to 22,200. Higher low of 22,120 is greater than 22,050. Higher high of 22,200 is greater than 22,150. The range is 80 here, with Nifty closing at 22,190. So the total day range is 200, that is 22,200 minus 22,000. The next condition is a magnitude filter. Each segment shift must be at least 10% of the day's total range, meaning each shift must be a minimum of 10% of the day's range. In our example, we have a day range of 200, 10% of that comes to 20. So each segment should progress the frontier by at least 20 points. S1 to F2 shift, the high moved from 22,100 to 22,150, which is 50 points, so that passes the criteria. S2 to S3 shift, the high moved from 22,150 to 22,200, that's 50 points again passes the criteria. The third and the last condition is what I would call the conviction condition. The close must finish in the top 25% of the day's range for an uptrend day or the bottom 25% for a downtrend day. In the example, the total range was 200 points, 22,000 to 22,200. Top 25 threshold means any close about 22,150. Nifty closed at 22,190, so that qualifies too. In other words, based on my definition of a trend day, it is not enough for the market to simply close in green or red. The entire intraday range structure must progressively shift in one direction. And the session must also close strongly near its extreme to qualify as a genuine trend day. With this as the definition, let's see how many such days do we get in a year. What you see in the chart is the number of uptrend days in green and the number of downtrend days in red for each month. For example, Jan 2023 had 1 uptrend day and 2 downtrend days. On the right, you see at the bottom 2023 had 28 uptrend days and 18 downtrend days in total. As you can see, trend days seem to be evenly distributed. Every month, there seems to be at least 2 to 5 trend days. Each full year, on an average, has close to 45 trend days, which is 18% of the days. Now, some of you may ask me, Sandeep uncle, can we predict a trend day? Well, who in their sane mind would not want to predict a trend day? And if there was a way to predict it, who in their sane minds would publicly share it? Well, on a serious note, it's hard to predict something that's rare. It's an event that happens just 18% of days. But there's something that I can tell you, if at all. Mondays and Fridays stand out for uptrend days, and Thursdays and Fridays for downtrend days. In essence, if you're hunting for trend days, Monday, Thursday, and Fridays are your days. Another interesting pattern. The next day after a trend day is relatively quieter most of the times and does not extend the range of the trend day. In that sense, the next day after a trend day is more predictable in terms of its range. Take a look at the data. In 2023, the next day's mean range after an uptrending day was just 95.6% of the trend day's range. Meaning, if the trend day had a range of 300, the next day's mean range would approximately be 287 points, and if we had a downtrending day, the next day's mean range would be approximately 83% of 300, which would be 249 points. So as a trader, it's easy for you to know the boundaries of the trade the next day. In summary, scalping depends first on range, how much an instrument actually moves. The data suggests that while products like Bank Nifty offer large moves, they also come with higher risk, which is why Nifty can be a more practical alternative, especially for beginners. One key insight is that most of the day's range is formed in the first 2 hours, while the last part of the session can still offer some meaningful expansion. more so when the morning range is unusually narrow. Also, it helps to study initial range breakouts and trend day statistics to better understand how far price may extend and when a session is more likely to trend and when it's more likely to mean revert. Overall, the message is that scalping, as with anything else in life, should not be approached randomly. By studying range, time of the day behavior, breakout follow through, and trend day tendencies, traders can build a more structured and probabilistic understanding of intraday price action. That brings us to the end of this part 2 episode on scalping. In the next episode, we will look at more ideas to understand market structure better, and in the subsequent episode, we will look at specific entry and exit rules. I hope you found this episode useful and interesting. I know this was a heavy episode filled with data, so do watch it again to understand it better and maybe have a cup of coffee and a notebook handy to help you follow along. Do share your questions, thoughts, and feedback in the comments. I will do my best to respond. Thank you for watching and see you in the next one.